The U.S. just sold a record-breaking $100 billion of 4-week T-bills in one shot. Are we really in T-bill danger territory? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. So, it was an anxious week for some market participants as the Treasury sold $100 billion of the 4-week T-bill in one single auction, the largest of its kind ever. And in the same week, President Trump nominated economic advisor Stephen Miran to be the new Fed governor, replacing Adriana Kugler on the Fed board. And if Stephen Miran's name sounds familiar to our Diamond NestEgg regulars, the reason probably is because Miran's paper forms the basis for the Mar-a-Lago Accord, which we talked about extensively in this video a few months ago, in terms of what the impact would be on our treasuries. I've linked the video in the first pinned comment below for reference. So, in light of all this, here are the 3 topics I'll be covering in today's video. 1. Did the $100 billion T-bill auction fly or flop? And what can it tell us about the future outlook for treasuries? And in this section, we'll also talk a bit about whether we should expect lower rates if Stephen Miran gets confirmed as Fed governor. 2. Which treasuries rose the most and which ones fell this past week? And 3. What are the predicted yields for the upcoming week's treasury auctions? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Did the $100 billion T-bill auction fly or flop? And what can it tell us about the future outlook for treasuries? So, to give you the headline first, this record-breaking $100 billion auction of the 4-week T-bill went probably as well as it could under the circumstances. The Treasury easily sold the entire $100 billion, or even a tiny bit more, at an investment rate of 4.374%, which is more or less in line with where the yields for the 4-week T-bill currently stand in the grand scheme of things. Now, it's clearly a good sign for market stability that this auction, as well as the other Treasury auctions on Thursday, went pretty much smoothly. However, it also reminds us how big our national debt pile has become. Even an auction as large as $100 billion is only about 1/300th or 0.34% of the $29.5 trillion in federal debt held by the public. As we've said many times before on this channel, the U.S. has a problem with our ever-growing national debt, and sooner or later we'll need to do a bit more about it than currently. But right now, there's also another more technical discussion going on in the markets. Is the Treasury issuing too many short-term T-bills? Or put another way, shouldn't the Treasury rather sell more long-term T-notes and T-bonds for more stability in the markets? One of our super savers, William, sent us this Wall Street Journal article not too long ago. Trump and Bessent bring new style to managing America's debt. In a nutshell, President Trump and Treasury Secretary Bessent have both said that they want to issue more short-term debt for the time being, while they wait for rates to come down. Only then would they start locking in these lower rates with more long-term treasuries. And not everyone likes this approach. Per Bloomberg, Wall Street sees risks to U.S. relying too much on T-bill issuance. And the argument for not relying too much on T-bills generally goes as follows. Yes, long-term treasuries cost the government a bit more than short-term debt now that the yield curve is positive again. But the advantage of long-term treasuries is that you know what you have in your pocket, so to speak, and don't need to refinance huge amounts of maturing T-bills basically every single week, with all the uncertainty and risks this entails. So, let's do what we always do in such situations and take a look at the facts. And let's start with the latest quarterly refunding statement from July 30th. The Treasury issues these statements to give the market advance guidance about the auction sizes that will come to market in the next 3 months. And indeed, the refunding statement confirms that the Treasury anticipates maintaining nominal coupon and FRN auction sizes for at least the next several quarters, which is another way of saying that it will keep the issuance of Treasuries with a maturity of 2 years and above essentially stable at current levels. The only exception seems to be Treasury Inflation Protected Securities, or TIPS. The Treasury plans to increase the September 10-year TIPS reopening auction size to $19 billion and increase the October 5-year TIPS new issue auction size to $26 billion. But of course, the increases in TIPS issuance by a few $billion will not really make much of a difference in the big picture. So if the Treasury keeps the issuance of longer-term Treasuries basically stable, this means that they'll need to issue more short-term T-bills because, well, we're still running a budget deficit to the tune of a bit below $2 trillion a year, and we need to keep issuing more debt to raise the cash needed to fund all this spending. So the question really becomes then, will these additional billions in new short-term T-bills be too much? At which point could that impact the stability of the market? Now, no one knows for sure, but there are two ways of looking at it. First, we can look at how much of our debt is currently financed by short-term T-bills. And as you can see on this chart from the Treasury's own Office of Debt Management, it's 20.7% at the moment. This is below the historical long-term average of 22.4% since 1980, but slightly above the 20% rule of thumb that is sometimes reported in the media. And as a side note for a community of bond experts, the current share of TIPS of the overall federal debt outstanding is rather low in the historical perspective, which may explain why the Treasury plans to increase TIPS auction sizes by a bit. But let's compare the second perspective now, the weighted average maturity of marketable debt outstanding, or WHAM for short. This measures how long on average the national debt takes to mature, or in other words, for how long the interest on all outstanding treasuries is fixed on average. As you can see here, the WHAM currently stands at 71.9 months, or almost exactly 6 years, which is actually higher than the long-term average since 1980 of 61.3 months, or a bit above 5 years. So despite all the hoopla about too many short-dated T-bills being issued and the risks to the U.S. of relying too much on short-term T-bill issuance, the weighted average maturity of marketable debt outstanding is actually longer now than it has been historically. Of course, whether this is good or bad depends entirely on your perspective. If you want market stability, this helps. On average, we fixed our national debt for longer than we mostly have in the past. On the other hand, interest rates are high right now, and if you think they'll come down soon, as President Trump and Treasury Secretary Bessent do, then it makes sense to have some flexibility and issue more short-term T-bills right now while waiting for those rate cuts to come through. In my mind, and looking at the data that we've pulled together, I don't see any eminent red flags. The refinancing strategy of the Treasury seems not unreasonable, as both the overall share of T-bills as well as the weighted average maturity of our national debt seem comfortably within the range of historical ratios. Meaning, for those of our members who've asked, our personal strategy with Treasuries has not changed. We're still laddering T-bills on the short end, and we continue to selectively pick up a few new long-term treasuries, such as the 20-year T-bond and some TIPS, when we see expected yields that we like. But we are keeping an eye on any potential rate cuts to see whether we should lock in some longer-term bonds, and or even annuities potentially. Which brings me to the nomination of Stephen Miron as a Fed governor, at least on a temporary basis until January 2026, because as it appears currently, Miron will only serve out the original term of Adriana Kugler, who resigned last week. Miron is currently not seen as a candidate to replace the current Fed chair, Jerome Powell, from what we could gather. Miron is the current chair of the Council of Economic Advisors, and as I mentioned earlier, Miron's paper forms the basis for the Mar-a-Lago Accord, which we talked about extensively in this video. Again, link below in the first pinned comment for reference. JP Morgan analyst Jay Barry thinks that Miron's appointment may be one more reason that we see lower rates sooner rather than later. Miron has consistently argued that the Trump administration's trade, immigration, and deregulation policies are all disinflationary. This might indicate that he supports a more dovish Fed policy, as Bloomberg reports. bringing us nicely to the next section of today's video, where we'll have a look at how Treasuries reacted to this week's events and whether the market may already anticipate a rate cut in September. Which Treasuries rose the most and which ones fell this past week. Here's our usual table with Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. All maturities below 1 year are down, while all maturities 1 year and above are up. We haven't seen such a clear-cut picture in a while, I'd say. There is, however, still a bit of uncertainty and noise in the data. For example, the yield curve is positive if measured by either the traditional comparison of the 2-year against the 10-year, or the 1 month against the 30-year. But there's still a dip, as I would call it, and the lowest yields are not found at the short end, but right in the middle, the 2-year and the 3-year here, at 3.76% and 3.7% respectively. So, it seems the bond market hasn't quite made up its mind yet on the finer details. What it does seem to be preparing for, though, is a rate cut at the next Fed meeting in September. This is also reflected in the latest CME Fed Watch tool, which shows an 87.4% likelihood that rates will be cut by 25 basis points in September, from between 4.25% and 4.5% currently to between 4% and 4.25%. And per this Market Watch article, it appears that JP Morgan says it now sees 4 Fed rate cuts on the horizon as Trump nominates Miran to the Fed. But then again, no one can predict the future with full certainty, and even the CME tool changes from week to week. While it still assigns an overwhelming probability to a rate cut, this 87.4% is down slightly versus the 89.8% from last week. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. Again, increases in rates are shown in black, and decreases in rates are shown in red. The 1 month, 1.5 month, 2 month, and the 30-year are still slightly up for 2025. However, like for our weekly comparison, we also see this dip in the middle, where the yields are still significantly below their January 2nd levels, especially for the 2 to 10-year maturity range. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. So now that we know where Treasury yields ended the week, and that it looks like the market may be anticipating lower rates as soon as September, let's move on to the next section of today's video. What are the predicted yields for the upcoming week's Treasury auctions? If we go to Treasury Direct's upcoming auctions page, we can see that all the weekly T-bill auctions are happening as usual. Other than that, it's pretty quiet on the Treasury auction front, with no T-note, T-bond, or TIPS auctions on the schedule. At the time of this taping on Fidelity's platform, here's where the expected yields stand for the T-bills that have been announced already. Please keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And for those of you who subscribe to your financial journey, check out this latest video here from Ava on the 7 levels of wealth, a topic that often pops up at the Lammer family dinner table. Which level of wealth are you at? And as always, if you want to learn more about bond investing and building out a bond portfolio while rates are still attractive, then check out this video here on our bond courses, because rates haven't been at these levels on average in decades. I've also linked all the details on Ava's video, our bond courses, and our YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.